my own personal investments, which we show at the end of each report, the disclaimer, are heavily in silver miners as opposed to gold. Okay, though gold is the mama, it's going up. Silver has both outperformed and underperformed gold on a routine basis over the decades. Silver's up 42% on the year today. Gold's up 37%. And yet most people still think silver's lagging. It's not. It's catching up to gold. And there are certain technical levels not far above where we're trading right now that if silver spread versus gold can reach those levels, I think in the next handful of months between now and the end of the year, silver's likely to be in the $60 to $70 price range.
Silver may look overlooked today, but history suggests it's setting up for explosive outperformance. Michael Oliver emphasizes that silver's potential is often misunderstood when measured in nominal dollar terms, since the currency itself has deteriorated significantly over time. He explains that silver's 1980 peak of $50 would already translate into several $100s in today's debased currency, while even the 2011 highs would equal well over $100. Although many view silver as lagging, it has outperformed gold this year, gaining 42% compared to gold's 37%. With expectations of a surge towards $60 to $70 in the coming months, Oliver believes silver is positioned for a powerful move back toward its historical normal 2% ratio to gold. While gold remains on a steady upward path, Oliver leans more heavily towards silver and silver miners in his own positioning. He highlights silver's cyclical nature, often alternating between outperforming and underperforming gold, but stresses that its core identity is as a monetary metal rather than just an industrial asset. In his view, the current environment of declining confidence in institutions and accelerating fiat currency decay makes silver especially attractive as both a hedge and an opportunity for outsized gains. Oliver also draws attention to the broader context of stagnant global benchmarks. The US dollar index, for example, still trades near 97.5, the same level it held a decade ago in late 2015 when gold bottomed at $1,050. Likewise, the Bloomberg Commodity Index has oscillated sideways for 10 years with no real progress. For Oliver, this stagnation highlights the failure of fiat currencies and conventional commodities to generate lasting value, reinforcing his conviction that silver is poised to reassert itself as real money and a driver of wealth in a fragile financial system. If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll continue delivering sharp insights and expert perspectives on the forces driving gold, silver, and the broader financial landscape. Thanks for watching.
I think it's really relevant. Yeah, as I said, so many years have passed that the real value of the money unit that we're measuring by, the dollar in this case, or you could do it with euros or anything else, is just meaningless. The decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds, 100 to 200, would not surprise me. But we're taking it in segments. And my own personal investments, which we show at the end of each report, the disclaimer, are heavily in silver miners as opposed to gold. Okay, though gold is the mama, it's going up. Silver has both outperformed and underperformed gold on a routine basis over the decades. And if you go back 50 years, and look at what is the highest relationship of silver to gold in any one of those given years, and plot it. We have a graph we put in the latest report. 2%, meaning divided an ounce of silver into gold. Silver was 2% of the value of gold in 20 of those 50 years. So it's not absurdly, to be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher the price of gold. Well, right now silver's 1.12%, still dirt cheap. It got under 1% recently, which is historically very, very low level. When you see that, buy it. But when that spread turns up, and it's been turning up sharply, well, just for example, this year, people don't realize this. Silver's up 42% on the year today. Gold's up 37%. And yet most people still think silver's lagging. It's not. It's catching up to gold. And there are certain technical levels not far above where we're trading right now that if silver spread versus gold can reach those levels, the spread chart and the momentum of the spread chart, which is what we look at, both technical metrics, have very clear pending triple top breakouts, meaning levels that they've stopped twice before. And if you punch up through that, these levels go back several years, by the way, you're breaking out big time. So if you looked at these charts, these spread relationship charts, and treated it as a price chart, you'd say, oh boy, you break through that and I'm going to blow the cork off this thing. The spread is about to do that, I think. And when it does, I think in the next handful of months between now and the end of the year, silver's likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. Well, that's a huge move because we're talking almost doubling the current relative value of silver to gold very rapidly and going up to that, quote, normal 2% level. Because we're, like I said, 1.12% right now. So anyway, I think there's a huge explosive potential in silver, coincident with the rise in gold, but advancing more so. And so that's why my personal emphasis is in the silver aspect of the monetary metals. First off, I don't look at it that much, and I try not to, okay, because I don't want to be distorted by a notion of fundamentals. Why? Because quite often fundamentals, even if they're true, even if your assumptions are correct, that doesn't tell you about the timing. Mm-hmm. You could be right and not be right in terms of price reaction for 2 years, okay? You know, do you remember the movie The Big Short?
Yeah.
The guy, these 3 or 4 analysts around the country, different guys, didn't know each other, all came up with the same conclusion. There's going to be a mortgage crisis. There's no way around it. They pounded the table, okay? That was 2005, 2006. And it wasn't until late 2007 that the stock market finally topped. And it wasn't until 2008 finally that they said, I was right. So you get the point, fundamentals. Mm-hmm. Okay. Silver does have certain unique, we know the industrial aspect. It used to be, you take a picture, that silver was a key factor in photography. Now it's a key component of solar cells. And it's also, as I understand, essential in the big AI explosion because silver is such a good conductor. Okay, well, the numbers that I've seen, and I don't know the validity, they probably are because I see them from too many places, of supply demand on the industrial side is very tight. The annual production of silver is not increasing. It's plateaued and demand is continually increasing. And by the way, China is one of the chief demanders of silver because they're like 80-90% of global solar production, solar panels, which silver is essential. So anyway, that could become a factor where, let's say we cross 50 and CNBC needs an excuse to explain it, okay? And that's a good excuse. Oh, well, the industrial demand. Well, that's true now, but sometimes it takes a while for that reality to finally be used as the excuse. The bigger issue is silver's money, just like gold. A lot of people like to treat it as not monetary metal, but as history shows it has been. In fact, the U.S. has had silver as official money too. So I think the crisis we're facing in global assets, global suffering, economic suffering, not just U.S., is going to be such that you're going to get a lot of things thrown up in the air in doubt, where you doubt the validity of a certain institution to provide what it's supposed to provide, like the central bank. You suddenly realize the value of the stuff in your wallet is decaying so rapidly it's ridiculous. The dollar index, which is what most people look at, is 70% comprised of euro and yen. So what you're doing is you're looking at the euro and yen upside down, basically. Also the British pound, Canadian dollar, Australian dollar, etc. But the primary weight is the euro and the yen in that order. Okay. The dollar index right now is trading 97.5 as we speak. Okay. You go back 10 years to December of 2015, when gold made its low at $1,050. The Bloomberg Commodity Index is where it is right now, 10 years ago. But you could draw a line sideways. Yeah, it's been above it and below it, but it's net for 10 years sideways, and yet gold has tripled in a half.
Michael Oliver stresses that gold's strength lies not in short-term market stories but in the deeper erosion of money itself. Over decades, currencies such as the dollar, yen, and euro have lost most of their purchasing power, about 90% for the US dollar alone, while gold has preserved its value through every cycle of devaluation. Unlike equities or other assets that struggle to keep pace with inflation, gold consistently asserts itself as real money, rising in response to fiat's decline long before policymakers acknowledge the damage. For Oliver, this enduring resilience underscores why gold remains central in a financial system increasingly defined by manipulation and decay. He also highlights the Federal Reserve's inability to stop market collapses once reality takes hold. Policy moves like rate cuts or money printing may spark temporary rallies, but they ultimately feed instability rather than prevent it. Oliver recalls October 2008, when gold briefly dipped alongside equities, only to recover quickly and move higher as stocks continued to sink. When quantitative easing followed, equities still languished, but gold surged, proving once again that when monetary manipulation fails, the metal acts as the true haven. Let's get back to the interview.
Yeah, although a lot of people like to go day to day and they see a story and think, oh, this is important or this is important. In fact, there's a far bigger wave that's pushing gold. It always has. And that is the ongoing degradation of the money units. Whether you're yen, euro, dollars, whatever, they continue to degrade in real buying power because it increases supply dramatically decade to decade. About 90% for the US dollar every decade. So, when your granddad built the house at $4,500, now it takes the same median price home, $450,000. That's called the degradation of money. And so, it shows up, gold holds its value versus that ongoing degradation. It is money, period. And so other markets will also tend to try to follow the degradation of money, like stock market. But gold always, over time, continues to hold its value and outpace those other assets. And therefore, the interest rate issue. If the economy weakens, yes, the central bank will then have an excuse, justification to put full throttle on it again. They're always got their foot on the pedal. I mean, they're always printing money. They're always, money supply expands. Interest rates are arbitrarily set by a central governing body. It's the most essential commodity in human interaction between you and me, or me and somebody who makes a product in China or somewhere else. I don't know who they are, don't meet them, but I like what they do. They like the money, okay? But if what we're transferring back and forth is degrading in value, sometimes quickly, if you're in Venezuela, for example, or Weimar Republic, you get the point. But governments deem that they have the right to control that essential commodity, quantity of it, the price of it, interest rates. And so you have a manipulated, effectively socialist money. And so wise men from above are deciding, and when they see an excuse to, print, they do, and they go crazy. Since 2009, actually it was October 2008, the Fed went to QEs. They took a chapter out of the Japanese book, and they started to go berserk, and they kept the 15 years since, 16 years now, interest rates were effectively at zero 10 of those years. And even when they raised rates during that time, and if you go back 50 to 75 years, you'll see that Fed funds rate was still in the lower quadrant of history. So they manipulate the money, and that's what causes gold to go berserk. And therefore, this data point that we saw today is merely another little excuse for them to go berserk. And, Powell to finally give in to the other voices on the Fed and to the president and all this stuff. Print. So gold knows that. That's why. Simple as that. It's a broader issue than just day to day. It does work because once they help create a boom through usually monetary policy, and you can see it in the money supply or the interest rates, so forth, the stock market will participate and enjoy the party, And then when the stock market tops, ultimately it's overdone reality for a certain period of time. It's overshot any realistic level, and primarily driven by monetary policy. And it breaks, and when it starts to break, reality takes over, and the Fed can't stop it. They never have been able to do that. You go back to .com, and that peaked. It was a laborious stock market top. It wasn't like a top and a collapse. It was for a year. You toyed around between January 2000, 2001, sideways, made people feel comfortable. And in January 2001, about 6 months after the top tick in the S&P, they cut rates twice and continued to cut rates all the way down to 2002 low. Yet during that time, NASDAQ 100, representing the dot-com, dropped 82%. So they didn't protect anything. 2007 to 9, same story. They cut rates surprisingly. It was an ambush. September 2007, market went up, poked a new high right after that, marginally, but made a new high, all-time high, in fact. That was the top. They cut rates all the way down. Market went down anyway. And it's going to happen this time. The only difference is if you stand back and look at 23 to 29, 1994 to 2000, 2002 low to 2007 high. The duration was much shorter, usually 3, 4, 5 years. And the multiple gain in the S&P, for example, is usually double, maybe triple, maybe a little bit more. But duration and multiple gain, there's no comparison this time. You go back to the 2009 low, and we've got a 10-fold advance in the S&P over 15 years, and we've got a 20-fold advance in NASDAQ 100. So dimension-wise, it's far bigger, duration-wise, far bigger, meaning far more errors have been built into the system because of the distortion of the money unit. And in this bull bubble, we never had rates at free money, 10 of the 15 years, and low at the other years, lower than normal. And then the money supply also expanded rapidly. So you can understand why the bubble occurred. But once it breaks, reality tends to take over, and the Fed can take out all the hoses they want and turn on the spigot, and it just won't help. The money will go elsewhere. Where does it always go? Well, it never has, but once, there's a real world out there. Now, a lot of people like to think, no, there's a handful of academicians who are like gods, the Wizards of Oz up there. And when they wave their wand, that's reality. Well, no, it's not. They can distort reality for a time, defy reality, distort the money units we use to measure things, make decisions upon. I mean, when you want to buy a new house and the mortgage and all these things, or you're a factory owner, want to expand your capacity, hire more employees, or a government wants to spend, the cost of money is one of the key ingredients in your decision process. Well, if that factor is totally distorted, fake, Cheech and Chong money, okay, then you make a mistake. And when you make a mistake, it's made. Now, it may be a couple of years later before you finally realize it and reality comes back and gets you. But the exposure of all those myriad of micro and macro errors that humans make, companies make, state governments, federal governments, when it finally hits, it's so big, it's a wave that even the central bank can't stop. So when they print the money, it's always gone somewhere. In other words, not everything goes down. You go back and look, 29 to 32, 2000, 2002, 7 to 9, et cetera, et cetera. You look and you'll find there was usually two alternatives. Always one of them was gold. Now back in the 29 to 32, you couldn't do it because they banned it domestically. But home stake mining went up like 1,000%, okay, during that time. And then the other times, if you look back 2000 to 2002, gold made a low in 2000, 2001, and advanced all during that time and continued on. 2007 to 2009, the stock market had a net major decline. S&P, gold had a major advance and continued to 2011, in fact. And by the way, a lot of people think that, they remember October of 2008, where the S&P did finally, a full year into its bear market, produce what you could call a crash-type month, 35%, whoosh, in a matter of weeks. Gold did participate in that because it needed a correction anyway. But look what happened immediately after that. The context was still gold was going up, and that was a very sharp correction. Within several months, gold was back at its high, and S&P continued down till 2009. Of course, that's when they came in with QE in October of 2008, right after that crash event. That's when Bernanke said, okay, let's go full throttle. Well, what happened? S&P continued down and gold exploded back to its high.
Gold and silver stand as pillars of value in a world of rising debt, weakening currencies, and volatile markets. While gold offers stability and long-term security, silver adds the potential for sharper, faster gains, making the two a powerful balance when held together. Short-term corrections may unsettle investors, but history shows they often open the door to greater opportunities, with miners positioned to multiply as valuations catch up. Holding bullion alongside select miners, while maintaining discipline against debt, provides both protection and growth in today's shifting financial order. Are gold and silver pullbacks the best time to buy? Stay tuned. If you're interested in real, data-backed insights on the financial system, be sure to like and subscribe so you never miss our weekly updates. Thank you for your support, and we hope you enjoy the video.